So let's take a look at how we draw Fibonacci retracements onto our charts. Now, before I actually get into this, I just want to reiterate the fact that if you look on Google and you look on some of the forums there, different people have different ways that they like to use Fibonacci retracements. All I'm doing here is I'm showing you the way that we use them for our trading and the way that we find them to be successful. I'm not saying it's the only way, I'm not saying it's the right way. I'm just literally saying that this is the way that we use them, and it's actually one of the more common ways that people use these Fibonacci retracements in their trading. Okay, so to start with, we need the Fibonacci tool, and that's this guy up here. If you can see this with a little F next to it and a few dotted lines there, that's the Fibonacci retracement tool. So what you want to do is you want to click on that level there, and you can see that we've now selected it. When we go to our charts, notice that my cursor is now turned into a little crosshair with little lines on it. What we want to do for Fibonacci retracements is we want to connect the swing highs to the swing lows, or the swing lows to the swing highs, and vice versa. Okay, so if we were to draw a Fibonacci retracement here, let's say for example that we can't see what this price action is here, so we've literally just got the market come down to that particular level there and we haven't seen what's happened after it. We would connect to the swing high here, you'd click on it and drag it down to the swing low, and then as mentioned in the slides, we'd be looking for the price to react to one of these levels here. So you see what the 23.6, the 38.2, the 50, 61.8 and 78.6, or the 100 is like literally your last line of defense there. And as we can see that the price actually reacted to this 100 line, it didn't react to any of the other levels, and obviously it rebounded from there from the 100% retracement and carried off on its merry way. Now let's connect some other swings here so that we can get into the habit of doing it. So again, I will connect this swing high here down to this swing low over here. Okay, so we've got swing high down to swing low, and we'd be looking for the price to react to one of these levels here. And as we can see, the price reacts, it rebounds off of the 50% level, which actually also happens to coincide with a previous level of support, which is now becoming resistance. So we've got the Fibonacci retracement tool there in conjunction with a previous level of support if we cast our eyes back over here, which is becoming resistance. So this is the way Fibonacci works. Now, Fibonacci isn't a magic bullet. It's not going to work every time. All we're using these tools for is to give us an indication of where price could react. And if price does react to that level, then that just gives us a little bit of confidence that the price is then going to turn around and continue in the direction of the major trend at that level. So again, let's move this Fibonacci tool. Let's move the charts to the left a bit, and let's connect this swing high. Okay, so our last swing high to our swing low, and see if the price reacts with one of those levels. And again, let's take a look here. So the market is swung down. We draw on our Fibonacci retracement. We're expecting it to react to one of these levels, okay? And sure enough, the market comes pretty much pit perfect to the 50% level, which again, if we cast our eyes back here, is a previous level of support, which is now becoming resistance, and then the market continues off again on its merry way. So this is the way that we use this tool. We can see that it's actually a very, very powerful tool. We don't want to use it in isolation. We prefer to use it with a previous level of support or a previous level of resistance. And again, these levels are just giving us an indication of where we believe price could react. So again, let's move this down once more. So we connect swing high to swing low, put our Fibonacci retracement in there, and as we can see this time, it reacts to the 38.2 level as opposed to the 50 level. But again, a previous level of support has now become resistance. What I'm going to show you now is let's now move over to a different chart and see if we can see these on a different chart. So this was the dollar franc on a daily basis. Let's now jump across and look at the euro dollar on a 4-hour basis. So this is the euro dollar on a 4-hour basis. And again, if we're connecting our swing highs to our swing lows, let's take this price action over here. Let's get our Fibonacci retracement tool. So again, this little guy up here on the top, let's select it. We come to our chart, we click on our chart, we hold the left mouse button, we drag it down, and as you can see, the market has also reacted to that 50% level, which again, if we cast our eyes back, also happens to be a previous level of support, which is now becoming resistance. All right, now guys, you can't really make this stuff up. You know, this is what's happened live in the markets. We've traded these levels live in the markets. Okay, this isn't something that, you know, we're just creating a system from nowhere. This is the foundations to successful trading if you use price action, and all of these tools help us to identify where we expect to see some sort of you know, price action reversal or candlestick reversal. Nothing more, nothing less. Now again, what I've just done there is I've connected this swing high to this swing low, and we're looking for price to react to one of these levels here. Sure enough, price comes up, finds some resistance on the 50% level, which also happens to coincide with the previous level of support over here, becomes resistance, well, between the 50 and the 61.8, and price reacts to that level and sells off. All right, so I hope you guys are getting an idea as to how we can use these levels for our trading. Okay, we want to be connecting, if we're in a downtrend, we're connecting the swing highs to the swing lows. If we were in an uptrend, okay, we're not in an uptrend here, but just to give you an example, if we were in an uptrend, we would be connecting our swing lows up to our swing highs and looking for a reaction. Okay, now, as I said, this chart here isn't in an uptrend, so it's a bad example there, but just showing you the difference. So swing high to swing low if you're in a downtrend, swing low to swing high if you're in an uptrend, and then you look for price to react to those levels. You don't trade them in isolation. You use something like maybe a trend line or a previous support or previous resistance line to coincide with those particular levels, and then you look for price action to confirm those levels. Okay, we are anticipating, but we're reacting. All right, that's what we do as traders. We're not going to say, I have a crystal ball, I predict it's going to turn around at this particular price. What we're actually saying is, this is a level where I would expect price to react. If price does react to this level, then I have a little bit more confidence that this setup is actually going to pay me. It won't necessarily pay you, as we've already discussed. You know, we can't necessarily know that the next setup is going to make us money, or the next setup is going to make us money. All we know is that if we have an edge and we continue to trade that edge, then over, you know, a large enough sample size of trades, we should come out ahead of the game. So as always, now that I've shown you the concepts on the chart, I want you guys to go away, pick any chart you like, and start drawing these lines, these Fibonacci retracement lines in there, just so you become accustomed to how to use these particular levels. Okay? Until the next video, take care and thank you for watching.